Hello, this is Bike Bonds quarter 1 through 3 business plan presentation by Group 5. Members include Emiliano Acuna, Stephanie Guzman, Ting Ting Lan, Phil Pick, and Roman Rizik. So Bike Bonds strives to bring together families and friends with state-of-the-art carbon fiber bikes that are reasonably priced. This philosophy has paid off as the quarter 1 through 3 figures of revenue showed increase of 33%, and operating cash flow has increased 86% from quarter 2 to 3. This is all due to lean operations and positive cash flow focused philosophy. And Bike Bonds boasts as the first place in net income. At the end of quarter 3, the average value for the competitors was about $77,000. However, Bike Bonds placed first in net income with a value of about $107,000. So, continuing with the quarter 1 through 3 financial and market performance, at the end of quarter 3, Bike Bonds, the recreational brand, Seabreeze 2.0 required some room for improvement as some of the competitors provided better functional features for the customers, as Bike Bonds will be reviewing the competitors' features to revamp our features as well. A strong performer was Bike Bonds' mountain brand, Terra Explorer, as it had the highest market share amongst its competitors. And surprisingly, at the end of quarter 3, Bike Bonds' speed brand, our tertiary focus, generated more revenue than the primary brand, focus brand, Seabreeze 2.0. So Bike Bonds assessment of current circumstances showed that the global economy will be growing to about 3%, which is an improvement from 2%. However, customers are not willing to pay more price for the bikes. In order to face this current situation, Seabreeze product features must be improved to meet customers' needs. So our competitors for Seabreeze 2.0 showed better functional features for the customers, which allowed them to meet their demands. So Bike Bonds will be reviewing competitors' successful recreational brand to refine its features to increase demand. Competitors have been opening new stores in new cities, as Bike Bonds will be adding new stores in new locations to increase customer base and sales revenue as well. Bike Bonds' strengths and weaknesses include lean financial operations with conservative expenditures, which keeps the fixed and variable costs down. And Bike Bonds has healthy wealth and cash balance with high gross margins for mountain and speed brands such as Terra Explorer and Flash BB. Weaknesses include human resources management. Bike Bonds has some room for improvement to pay better and provide better benefits, and needs to provide better manufacturing efficiency and productivity while allocating more advertising dollars for its speed brand, Flash Speedy. Major problems and opportunities include, again, human resources management, to improve employee morale, which would lead to better productivity. Bike Bonds plans on providing competitive pay and benefits. Opportunities include opening new stores in new regions with high sales potential to increase brand awareness and sales.
Okay, so marketing for strategy for the next 3 quarters. So as we looked previously, a little background, Seabreeze was our target bike. We wanted to get this out to the market as consumers. The company spent a lot on advertising, meaning targeting the bike to improve it. We even created a Seabreeze 2.0 with different features. As the quarters progressed, we realized that we needed to switch. So this is a short graph of basically what we looked at, among other things, but the net demand. So Seabreeze was 137 bikes that were sold. Terra Explorer, which is a mountain speed recreation, was 231, and Flash Speedy was 177. So our advertising, our internet clicks, and all that was mainly focused on Seabreeze. Terra Explorer and Flash Speedy was not advertised compared to Seabreeze. But we realized that Terra Explorer was selling very well. So um, instead of like lowering the prices of the bikes, we realized that we needed to switch our segmentation. So Terra became our number one, our Flash Speedy became number two, and our Seabreeze 2.0 became our number three. So we decided to be smarter and follow the constantly improved features of products. So we're improving all our bikes. We're working on that in the upcoming quarters. You'll see the progression, and hopefully we're able to make all our bikes our 2.0. Different by superior customers rather than lower the price. Our brands have got a name for itself. You can see that without having such low prices, they are selling in the market. We are getting a good revenue and sales from it. Instead of focusing on the markets with higher competition, we concentrate on market segments such as Terra Explorer with high potentials and low competition, since a lot are targeting Seabreeze. Different profits in order to build stronger market shares in the future. So to be able to focus on what the customers want, what does our company stand for? And this is a Terra Explorer, a mountain bike where you can ride with your family, where you can go with friends, and a different type of bike. So as the quarters progress, that is our plan, that we're gonna be focusing Terra being number one, Flash Speed being number three, and our Seabreeze being our 2.0, our last segment market, and continue to improve the different features on the bikes as the quarters go by.
So looking over for the next 3 quarters in terms of sales channel strategy, we Pipelines would like to go ahead and increase sales channels for different regions, obviously expanding operations. Uh, while also doing that, they also want to expand in terms of sales and service staff count to help out with the operations. By increasing service staff to provide superior post-purchase maintenance service, but also we want to also provide a training for staffing for the next 3 quarters to help drive up sales. By doing this, also we will look to allocate more sales resources for Terra Explorer and Flash Speedy.
Hello, today I will be sharing the strategies of our group, bike bonds, and the human resource part. I wanted to start by sharing what the previous quarters were and seeing the differences between them so you can understand the plan. So when we started the company, our group discussed that we wanted to be financially stable, meaning that we didn't want to be that company that fluctuates on their salaries, that we wanted to focus on what we were giving our employees to always improve, to always increase, to always work towards something better. So at the beginning of quarter one, we started with very basic salaries. We did not match it to what the other companies, the other workforces were currently offering. So you can see the differences between them, but that was the strategy behind, which I'll talk a little bit more about it. So for production workers, the annual one was 10,000. We matched it to 7,000. There was no health and benefits. We really wanted to focus on the health benefits package, which we did a minimum package for it. 1 week of vacation, we were able to match that. 1% of pension, we were able to match that. For production supervisors, we did the same thing. So the annual salary was 14,000. We were able to do 11,000, but again, match it with the minimum package, 1 week of vacation, and still kept the same pension, which was 3%. For the sales force, we decided to keep the same as the market. So it was 17,000, 17,000, a minimum package of health insurance, 1 week of vacation, and we were able to increase the pension to 3% instead of 2%. The reason I talk about this is that the goal of the company, once again, it was to continue to increase, to continue to listen to our employees as the company kept getting bigger and getting known. So you saw that in second quarter, once we made a profit, we were able to increase that for third quarter, which was the annual salary was 10,000. We were able to do 10,500. There was still no benefits. Always in the beginning, we always thought that the health of our employees was very essential. So we did the minimum package again. We were able to increase instead of 1 week of vacation to 2 weeks. Percentage of pension kept it the same at 1%. For production supervisors, did the same thing. We were able to match it to the current salary, which was 14,000, being able to offer the minimum package. And then here, increase the vacation from 1 week to 2 weeks. And then pension to still be able to continue to leave it at 3%. For the sales floor, it is still was 17,000. We decided to increase it to 17,500 with the minimum package, 2 weeks of vacation instead of one, and then increase the pension to 3%. Like I said, the reasons that we continue to adjust our prices is always to go up. We will never go down in salaries. So once we're starting making a profit, we want to ensure that our employees are being recognized for the hard work that they're doing. Same thing with third quarter going into fourth quarter, that you see that coloration that of all the companies and the competitors, pedal pushers, pedal Paradise, Carbon Cycles, pedal pros, that you see that they have a salary from 10,500 to 11,500. We tried to match it since we were being able to listen to what our employees were requesting. So as the salary went up, they wanted to see different areas increase, which was the health and benefits areas. So we still matched the salary to the highest, which was 11,500. We expanded our health insurance to expanded coverage since that's something they were looking for. 2 weeks of vacation, which the norms was between 1 and 2 weeks, and still the annual pension of 2% with our production workers, the same thing. So the average salary was from 14,500 to 15,500, which here we went higher than them. We were 16,000, the average, being able to offer expanded coverage. We're working towards a goal, which is the full coverage. And the other companies are already starting to see being able to provide 2 weeks of vacation, which the norms here, you start seeing that is 2 weeks. So the increase of them. With Salesforce, we have always tried to match the highest, which in the average was 17,000 to 17,500, which here we went 18,500 with that expanded coverage, 2 weeks of vacation, and 3 pension. So what you see in correlation is that we never wanted to say a number that we weren't able to maintain. As we see the profits, our profits are going to different areas, and those areas mainly is for our employees, one of the biggest area, because if we don't have a strong team, we can't have a successful company. So in the next 3 quarters, the strategies that you're going to be able to see is that we implement what the feedback we're getting from the employees. If they want to focus on vacation and health, that is our focus right now. We want to get to the point that we're able to offer everybody full coverage regardless of their position, and as well as 3 weeks of vacation, which as we get in it to be able to match what we stand for our employees, which is a family business establishment that we create bonds and memories. We want to have our employees do that with their families as well. So that's why we focus since the beginning in benefits, which was the vacation, the health insurance, for them to be safe and sound. So we'll regularly be checking and upgrading our benefits as the quarters progress. We're going to be really focused on the feedback that we get from the employees. Thank you.
Hey everyone, so I'll be talking about strategy for manufacturing. So moving forward, we are planning to open a store in Rio. We didn't go with Amsterdam because that's where everyone has a store already. So we're trying to avoid higher competition. For fixed capacity, we are not adding a 3D printer in Q4 because we have more than enough, we think, for Q4. We will consider it for Q5 and Q6. We're looking to continue to increase compensation for the workers to bring up productivity. And we are also going to consider overtime for Q5 once the new store opens in Rio de Janeiro. But those are our main strategies for manufacturing moving forward.
All right, now let's take a look together at our financial strategy for the next 3 quarters. We're trying to maintain our current strong position of gross margins and achieve financial success mainly by operating profits. Since our financial position is quite strong right now, we want to maintain it with a healthy cash flow as well. Our strategy has always been to play it safely and avoid the risks. But at the same time, for the following quarters, we're considering increase some long-term investments to get some benefits in the future as well. And also, we're trying to improve our asset management, especially to improve the turnover rates of the fixed assets. Meanwhile, we're trying to focus on long-term growth and increase the shareholders' value in a stable and a steady way. Now, as next, let's take a look together at our pro forma financial statements. It's a reflection of the past, but also looking forward to the future. The first thing is to look at the income statement. So cumulatively, we had the strongest financial performance of all competitors, which is very impressive. Our key to success right now is our high gross margin and low operating expenses for the past quarters. However, surprisingly, our first priority brand contributed actually the least of gross margin, despite with the most marketing expense spent on it. The good thing, however, is that the third priority brand actually contributed the most of gross margin, though we didn't even spend a penny on advertising expense on it. Net positive income was achieved within a short time after the startup of the company, which is the best performance of all the competitors. Our source of income comes mainly from operating. That means we're trying to avoid the risks for the beginning to do some risky expansions. Our forecast for the next quarters for the income statements, don't be surprised if you see a negative operating income for Q4. This is due to our increasing marketing and investing expenses for long-term as well for Q3. The good thing is that the negative operating income is expected to improve from Q4, and therefore it will go back to positive again, because when our investments on marketing, new stores, and R&E is paid off, we will see a definitely big increase of the operating income. Also, a steady increase of sales are expected due to our shift of the priority of brands and increased expense on marketing. Earnings per share will be expected to increase stably afterwards, after the market share is greatly improved by the end of Q6. For the cash flow, for the past quarters, our cash flow is in a very strong position with ending balance of 833,337. A positive operating cash flow was achieved within a short time during the past 3 quarters, and we used no external loans to provide extra cash supply because our cash balance is so good. As a forecast for Q4 to 6, the same thing, a negative operating cash flow is expected for Q4 due to the increase of marketing and investing expenses for Q3. However, overall sufficient cash balance will be maintained for all quarters and can avoid external loans. The benefits of the long-term investments are expected to pay off from Q5 and ever since. For a cash balance, The assets are very liquid. Actually, more than half of our assets are cash or short-term CDs. However, we need to improve the fixed assets turnover rate, which is due to our low sales during the past 3 quarters of our Seabreeze brand. As a forecast, assets turnover rates will be greatly improved after all marketing efforts are paid off and the revenues are greatly increased. We're trying to get more interest income by putting more extra cash into CDs. A stable increase of earnings per share is expected for the following quarters. The same thing, we're trying to avoid risky expansion by using external liabilities.
Moving over to the sales portion of the tactical plan. As we say for the sales next 3 quarters, we look to open new stores in the region with sales potential, while also adding additional service staff and sales staff as well. We also look to provide training for a salesperson to increase human demand per store salesperson, and gradually increasing salary and benefits of sales force. This also goes hand in hand with continuing to provide a higher rebate on brands such as Seabreeze, while limiting rebate on Terra Explorer and Flash Speedy to keep a healthy gross margin.
As we previously discussed a little bit about our tactical plans and marketing, we really want to emphasize that reducing the advertising cost on Seabreeze was to be able to increase on Terra Explorer and Flashy Speedy, since we saw that Terra was our #1 selling and Speedy was our #2, and our Seabreeze was our #3. So being able to target and advertise in that order. We reassign and lower the price of Seabreeze since we saw that in the market that's the bike that is the lowest price. I think the lowest was about $548. But in order to be more competitive, but just because we lower the price a little bit, we didn't want to do that with all our bikes, especially with the Terra Explorer and Flashy, because we want to make sure that our brand speaks for itself. The features, what we offer, what the company stands for, really signifies on the price that they're paying for and the features that they're getting. So we didn't do that to avoid any confusion brand identity. We wanted to make sure it's still a very competitive bike in the market, that continues to be very competitive in the market. And then we coordinated with different departments on research in order to be able to identify what are the benefits that the consumers need for those bikes, what are the different segmentation features that we can use. So that is what we're going to focus in the upcoming quarters, being able to focus on features, on different resources to provide more benefits for the customers as they're purchasing these bikes.
All right, now let's take a look at our tactical plan of financials. So we like to increase our advertising budget for the next quarters to improve the market share. Many will spend advertising on Terra Explorer and Flashy Speedy. So this increase of the advertising budget is due to our belief that the revenue and the customer market share is should be our main source of income. Also, we will reduce advertisement on Seabreeze from Q4 and try to increase sales by lowering price instead. We're going to increase the internet marketing expenses as well to promote sales for all brands. Also, for long-term investment, we increase our expense on R&D and quality control so that in the future, we can get the benefit back by serving the customers better as well as getting a bigger market share.
Okay, so now for tactical and their manufacturing, we're looking to optimize our operating capacity. We're dealing with like stockouts and just kind of lower productivity from the workers. So we are trying to avoid stockouts, which lead to ill will losses, which we saw in Q2. We're also looking to ensure the quality of our products because there's been a few complaints about framing, cracking, and all that. So we are spending money to have the quality meet the standards. And we're also working to create a safe and clean working environment for the employees as they have raised concerns that they're worried about the environment and their health. So we're looking to make that a priority. And with that, that concludes our presentation. Thank you, everyone.